At this point, everyone is familiar with the founder and chairman of the Adani Group, Gautam Adani. While the title of the third richest person in the globe alongside the wealthiest person in South Asia, Adani was undoubtedly one of the most influential figures in the globe with a net worth of $127 billion as of January 2023. However, notice how he said was, as in a span of just 2 months, Adani saw declines in his net worth, and it was as low as $49 billion at the end of March. So what happened to the Adani empire that led to a downfall in group stocks? Was there any scamming or third-party politics involved? Or something shadier? This is something we'll explore in our video today. The founder of the reputed Indian conglomerate Adani Group, Gautam Adani, began his business career in 1980 and started with setting up his own diamond brokerage firm in Zawari Bazar, Mumbai. Being a self-made billionaire at only 20 years young, Adani returned to Gujarat and started handling an import-export business. The legendary empire of Adani saw its beginning in 1995 after it gained the contract to operate the Mundra port of Gujarat. Currently the largest multi-port operator in India, Adani Group is currently the largest multi-port operator in India. Not only ports, but Adani is also recognized as the largest private power producer, coal miner, and India's top private airport operator. Besides India, his reach expands as far as Australia. In February 2022, based on the reports from Forbes, Gautam Adani was able to surpass Mukesh Ambani for the title of the richest person in Asia, and consequently, the 10th richest individual in the world, with a net worth that exceeds $90.1 billion. By the end of the year 2022, Adani managed to increase his net worth to more than $150 billion, boosting him to the top of the list of the richest person in Asia and the second richest person in the world. As of January 2023, Adani had a net worth of $120 billion and held the third position among top billionaires. Unfortunately for Adani, American forensic financial research company Hindenburg Research had published a 106-page report with the leading title, Adani Group: How the World's Third Richest Man is Pulling the Largest Con in Corporate History. As you can tell, this wasn't good news. The report accused the group of everything, starting from stock manipulation and tax evasion to borderline accounting fraud. As a retaliation attempt, Adani Group released a 413-page report titled Adani Response Report on the 29th of July, pleading innocence and calling out Hindenburg's crime as nothing more than false accusations. The report even went as far as threatening Hindenburg by suing them in the International Court of Justice. However, the drama did not stop there. As a reply, Hindenburg published yet another report titled Our Reply to Adani: Fraud Cannot Be Obfuscated by Nationalism or a Bloated Response that Ignores Every Key Allegation We Raised. In said report, it was stated that 62 out of the 88 questions had no replies from the Adani Group, and as you can tell, things slowly but surely started to go downhill. One of the consequences of this was that the Adani Group faced a collapse in subsidiary shares. The name of Bangladesh was involved in the drama, as the Bangladesh Electricity Department possessed a 25-year power supply agreement with none other than Adani Power. After the whole issue, the Indian Parliament raised questions regarding the possibility of Narendra Modi, the Prime Minister of India, coercing Bangladesh to buy electricity from Adani, which put the country in a delicate position to say the least. The aforementioned report accused the Adani Group of having their stock market listed companies overvalued by 85%. Alongside, 5 out of 7 major concerns from Adani currently maintained a ratio below Standard 1. In layman's terms, the current ratio refers to the amount of total current assets against the total liabilities. A ratio below 1 indicates the possibility of a company falling into a liquidity crisis, which was kind of the case with the Adani Group in general. One of the main reasons behind their companies being overvalued was to facilitate intra-group funding among their concerns. In order to do that, Adani made a habit of borrowing from banks or other financial institutions with a pledge that would allow them to access to a certain amount of shares of the best-performing company from their concerns. Basically, by making sure everyone wins, at least those who are on their side anyway, Adani made sure companies that were financially struggling could easily back themselves up with support from Adani without any complications. This was the bread-and-butter method of Adani to fund one company to another by borrowing amongst themselves. Now, pledging such equity shares in the form of collateral is generally not a good idea, because once the prices start to fall, the lending bank can easily call in the collateral at any given moment. In a situation where the receiver does not have the additional collateral available, the bank can and will take steps to liquidate the pledged shares. Aside from loans, buying shares in the struggling companies in order to raise funds was another approach from Adani. As an example, from back in 2014, if Adani needed a transmission, they concerned Adani Enterprises and its two subsidiaries by purchasing equity. Adani Properties back then acquired a 9% share in Adani Transmission. The next year, Adani Tradline, yet another subsidiary, had their business booming and got listed in the market. And as a result, the subsidiaries got their money back simply by selling the shares of the sister concern. Do you see the pattern here? For example, companies that took part in the stakes got their return quadfold. This is one of many examples of how Adani built their vast empire. The Hindenburg report we talked about earlier also revealed how out of 22 people in leadership positions, 8 of the members had blood ties with the Adanis and took direct part in a ton of financial decisions of the group. As a family empire, the Adanis utilized a plethora of offshore shell companies in order to generate a higher level of valuation of Adani Group concerns. With a total of 38 offshore shell companies in Mauritius alone, and in order to manage them, Adani assigned Vinod Adani, the elder brother of Gautam Adani. According to the Hindenburg report, Mauritius wasn't the only place this was happening, as they had influence in Cyprus, AUE, Singapore, and even in a few Caribbean islands. These shell companies make sure the stock prices get overvalued through stock manipulation and large-scale buying and selling of shares. Fact check. Here's a list of companies that Adani has under their belt. Adani Transmission, 19.31%. Adani Enterprises, 15.39%. Adani Power, 12.88%. Adani Total Gas, 17.25%. Adani Green Energy, 15.14%. Adani Port, 13.76%. Adani Wilmar, 1.57%. Note that all of these offshore foreign funds and being in possession of these are in strict violations of the rules of the Security and Exchange Board of India. According to SEBI, the promoters of a publicly traded company in India cannot hold more than 75% of the shares in that company, and the remaining 25% must be seen as public stock. The Adani Group promoters holding more than 75% of their total shares, they manipulated the share price by creating an illusion of a share crisis in the market. You cannot help but admire the idea and dedication, but the ethical compass will always point in the wrong direction with this one. The report also indicated how these shell companies have no traces of any specific activities, meaning no details of employees, no independent addresses, and zero online presence. However, what they did have was evidence that pointed towards billion-dollar transactions through these shell companies without any disclosure. This means not only stock manipulations, but money laundering is also on Adani's list of questionable larceny. The accounting irregularities were being controlled by financial entities, which in theory didn't exist to begin with. This irregularity resulted in the frequent changing of their CFO. In the last 8 years, the CFO has been replaced over 5 times, which is basically a massive red flag on the concept of accounting ethics. Along with all of these major issues, the Hindenburg report accused Adani of 88 total allegations, and guess what? All of them were denied. Hindenburg also pointed out in a later report that most of these answers were simply missing from Adani's pseudo-reply. The result of these reports? January 25th, a day after the publishing date, Adani lost a total market capital of 55,000 crores. As the stock price took a nosedive as expected, the investors started suffering heavily from huge losses, like their key investor Life Insurance Corporation of India's combined investment crumbling down to 63 crores from over 81,000 crores. Not only that, but according to LiveMind, Adani lost a staggering 12 lakh crores in market capital in just a month. And if that wasn't bad enough, Adani Group suspended the $4 billion petrochemical project in Madhra, Gujarat around March due to investor concerns, and it all originated from one report from Hindenburg. Currently, Gautam Adani is holding the 24th position on the list of global billionaires, with a net worth of around $49 billion. As you already know, the general election is already taking place in India, and calling it a delicate situation would be an understatement. The ruling government party had to face a lot of heat from the opposing parties regarding Adani's issues to come clean. The lingering question right now is, will Adani be able to hold on to their heritage and, more importantly, the empire they've built in a situation where the government swaps seats? Or would they crumble and fall in the face of the new government and leave nothing to their name but a bunch of pages in the books of financial history? Only time will tell.